Worldwide Markets in FX Street. On central bank policy, do central banks have an end game? We're about to find out, I think, the next year or two. As always with these webinars, the chat is up. If you have any comments, criticism, jokes, or anything you'd like to add, please type it in and I will address it as soon as I can. I certainly like to do these things with input from the audience. So let us go. What you're looking at is perhaps not something which immediately appears to be on the topic. It's a chart of the three major central banks in the world. Forgive our British friends, you're not included in this. Of course you are, but I can't just put too many things up there. The yellow is the Fed funds rate. The green is the Eurobank, is the ECB main refinancing rate. And the purple is the Bank of Japan overnight unsecured call rate. The white line is the Chinese Yuan. And do we see anything rather interesting here? Which is key, although not directly from this chart, to what's going on with the world's economy right now. As the central banks were lowering their rates, and as the world economy was crashing, China's yuan for 4 years was increasing in value. Now think about that. And think about just think about the logic to this. The world economy here, evidenced by all of this cliff here in interest rates, Japan, womp, ECB, I mean the Fed, bloop, and the ECB, straight down. Now central banks don't act like that unless there is a precipitating crisis, which we all know, of course, there was. The financial crisis of the fall of 2000, which is still the dominant fact in the world economy almost 10 years later. Everything that we see when we look around at the economy, look at interest rates, we look at inflation rates, we look at unemployment rates, whatever you want to look at, everything is still determined by the fact and the reaction to the financial crisis, which tells you a couple of things. One, it tells you that it was much worse than I think many people realized. And two, that its sources are far deeper in the world's capital structure than anyone admits, and I think anyone really quite understands. Okay, but let's go. So we have this period here. Uniform reduction led by the bearded wonder, Ben Bernanke, in the Fed, of worldwide interest rates. Now, China is an economy dominated by exports. What you see, of course, what's not on this, what you see in this period, there are two interesting things here as far as the Chinese yuan goes. In the pre-crash period, yuan, which is this, which scale is it? This one right here, the yellow scale. The charts are doing something odd with it. Anyway, so this is the scale. So from nearly 8 down to about 6.8 or so in really just 2 years before the crash. So the Chinese economy is performing, and its currency, which of course determines the price of its exports, is rising. At the advent of the financial crisis, the Chinese froze their currency. It did not depreciate, it did not appreciate. Well, what does that tell you as far as policy goes? That the Chinese, of course, view the Yuan as a major component of their economic policy. I mean, you don't have to know anything else about this chart except the history of world capitalism at the time, and you can ascertain that the Chinese view Yuan as important. Okay, that's really not very brilliant. Then again in 2008, for basically 1, 2, 3, 4 years. Well, let's count it 3 years, okay? 3.5 years, to the middle of 2010, 1, 2, 3, and a little more years. The yuan was appreciating substantially. And throughout that period, central banks were essentially doing nothing. The Fed was already at 0.25, where it stayed for 1, 2, 3, 4, 6, 7, almost 7 years. It's a long time. Is there something in the Bible, 7 years of fat and 7 years of thin? There is. Japan has, the thing that you have to remember about the Japanese interest rates, they're on this scale over here. They haven't been above 1% this entire time. And most of the time they've been below 0.1%. So although you get the same unchanging rate, it's at a far lower level. And the ECB finally realized in 2008 they got to do something as rates come down. What else have we seen that's interesting here? Well, at this point here, the Chinese begin to devalue their currency. What happened in the fall of 2000, in the early summer of 2013? It was May. Mr. Bernanke made the first reference to perhaps having to end quantitative easing. That's the famous temper tantrum, rates tantrum, tapering tantrum as it was called. And at the end of 2013, what do we see? The Chinese begin to devalue their currencies. What's going on here? As the rates go up, as the anticipation, China's getting a jump on things here. They started devaluing 1, 2, almost 3 years ago, and nobody's paying attention until here. Until the summer of last year, nobody's paying any attention. And the markets have again gone and ignored what's going on in China. Look at this bit right here. This is almost as substantial a devaluation as right here. When the markets went bananas, the equity markets went bananas. Nobody's paying any attention now. If China's currency remains strong, as everybody else is attempting to devalue, then what happens? Well, if China's currency is tied, or its biggest basket, or say it's not the biggest basket, but I mean, China's currency is priced against two, a basket, trade-weighted basket, and against the dollar, but the one that tends to get referenced is, of course, the dollar. So if China's currency is tied to the dollar, market idea, and the dollar's value is going up because, and the euro is at 108 now, it used to be at 114, okay? Then China's value, the currency of the yuan, vis-a-vis everybody else, becomes more expensive. So in order for China to maintain its terms of trade, the yuan must devalue. So this chart is rather indicative of the effect that these endlessly manipulated rates have on currencies. What else has this forced China to do? Because, and I'm going to get to the central bank stuff in a minute, but I just want to encapsulate it in following what China's policies are. Because as with so many things, and I've said this many times out of China, about the only point that their statistics are reliable, third quarter in a row, they hit 6.7% GDP. Well, that's great. But not too many people actually believe that that's the real growth rate in China. But at the Yuan rate, the Yuan intersects with the world. So it doesn't matter what the hedged or fudged, if they are, statistics out of the mainland actually are. This determines the terms of trade. So if you're looking for indicators to actually indicate the state of affairs in China, then it's always been my contention, you look at the ones that cannot be fudged. This is one of the ones that can't be fudged because it affects relationships in the real world. It affects real trade relationships. So if you want to know how the Chinese economy is doing, look here rather than at their GDP numbers or industrial production numbers or any of their other numbers that are a bit goal-seeked when they come out of Beijing. Okay, so here we have a Chinese economy that in effect is telling us what the effect of the global pandemic of low interest rates has been. China is an exporting nation. China lives and dies by its exports, much like Germany, in fact, where half the economy is supported by exports. I'm going to deal with Germany and the EU in a minute. So all of this, from here to here, and it's my contention actually that I think the Fed probably will raise rates a quarter point in December, simply because nobody believed them anything if they don't do it at least this December. And after that, we're going to be back to the same thing. It looks like the rate we're going, we'll be getting a quarter point rise per year. Okay, so it'll take us another year and then another year. So get anywhere near normal rate. If we assume, even at the low end, if we assume that the Fed would like rates to, the Fed funds rate to be 2%, assuming, you know, they're saying, well, the normal rate is now lower and all this other stuff. Okay, 2%. We're at 0.5 now. We're raising a quarter point a year. How long is that going to take us? I don't know. It's going to be a while, right? So we have 2 more and then 4 more and then 4 more. Is this possible? Is there any reality to this? We're at 0.5% now. We raise to a quarter at the end of the year. We'll be at 0.75. How do we get to 2? 1.25, right? How many quarters is that? How many years is that at 1% a year? That's 5 years. Is there any chance at all that the economy avoids a recession, global and in the US, for the next 5 years? I think it's preposterous. So the Fed's bind is very severe, but we'll talk about that in a second. What this is telling you, since China is an exporting nation, that the global revival is not here. China was perfectly willing to increase the value of the yuan despite the effect that would have on its exports before we knew what the possible effect of all of these interest rates are. These policies from the world central banks, the idea that interest rates have a linear effect on economies at all interest rate levels, was a new idea. It was an experiment. It had never been tried before. And we are starting, I think, to understand some of us in some places slower than others. The effects of these policies on actual economies rather than on economists' equations. It's my contention that this here is the realization, because China was perfectly willing to devalue, to revalue its currency under the assumption that the world economy would revive, because that's what all the economists told us. It's a linear relationship between economic growth and interest rates. Well, it turns out not to be the case. This is not a theory. This is simply a fact. You just look around and you can see the empirical relation. Once that became evident, China realized that its policy of revaluing the yuan higher was a detriment. It stopped and reversed. Okay, now let's move on to some of the other more specific topics. Okay, here we go. So I'm going to start with the US, because the US is first off the proponent of this, the originator of the policy, the boldest of them. Well, actually, it's not. Okay, the Bank of Japan is. Nobody seems to pay attention to the Bank of Japan, but let's start with the US anyway, because I know the most about the US. I'm an American. I work in New York. I worked for many years on Wall Street. So the American economy is the one I'm most familiar with. And it is the best documented of all the economies. Okay. US GDP, annualized quarter to quarter, white. Yearly, what did I put up that 12? Oh, sorry. Average in the purple, and the Fed funds rate. So what we want to pay attention to is, of course, the Fed funds rate and the average. Either one works pretty well, but what we're looking for is the relationship. Remember, the entire rationale behind zero interest rates is the assumption of linearity. You could say a linear relationship probably sounds better, right? Is the assumption of a linear relationship all across the rate spectrum between economic growth and interest rates. And it's an inverse relationship. Of course, rates go down, spurs economic growth, rates go up, retards economic growth, with a delay, of course. And the policy prescription of the central banks in the modern era, say the Greenspan era, has been counter-cyclical. The economy starts to heat up, overheat, everybody's worried about inflation. It's a human function. I'm not going to blame it on central bankers or the military. It's a human function to fight the last war. Just as true in relationships as it is with military strategy, with economic strategy, anything you want, because we don't know the future, we only know the past. The future is conjecture, the past is documented. So the great problem in economics, which central banks took a great deal of credit for taming, was the inflation of the 60s and the 70s, at least in the United States, prompted by excessive money printing. Now, the Fed took that to heart. And look at I don't have inflation rates up here, but you can assume that the inflation rates were higher as well. Now, we all know what happened. In the 60s and the 70s, the government did not feel like paying for the Vietnam War, or didn't want to. Lyndon Johnson wanted to both do his Great Society programs, which involved spending tons of money, and prosecute the Vietnam War without raising taxes sufficiently to cover them. So we printed money and we got inflation. It's a very simplistic analysis, but we're going to go with it because it serves our purpose. And it's largely true. And that extended all the way through the administration of Jimmy Carter. And by the time Reagan got in, Carter had already appointed Paul Volcker. And Volcker, being a monetarist, took to heart the monetarist thesis. Everywhere and always a monetary phenomenon, inflation. Raised interest rates to about 12%. Squelched it, and it's been declining ever since. Now, the effect this had on central bank policy under Alan Greenspan was the idea that central banks had a great deal more influence over the economy than had been assumed before. That it was actually assumed that under the maestro, that they could largely control the economy. The success, which central banks took credit for, even if you can probably come up with, and I'm not going to do it here, a number of other contributory arguments for why inflation had this long decline. It looks just like this, actually, through that period. Became the epitome of central bank activist policy. The assumption being, as Mr. Greenspan was wont to credit, central bankers are now the directors of the world economy. That assumption is a great article in The Guardian yesterday or the day before about the ascent of the experts, how it is that we have given so much of our political and economic lives over to the control of experts who, in fact, are nowhere near as competent as they maintain. And I think the central bankers are a perfect example of this. So through this period, it's assumed that central banks have this magical ability to manipulate the economy. What's lost in this entire period is any sense of proportion. Or I might say any sense of humility, too. It is far easier for politicians and for people, anybody, to give control over to, and it's also inherent sort of in progressive ideology, that there are such things as experts in various fields who are better equipped than the individual citizen to run things. This philosophically, I do not buy at all. It certainly hasn't been true in the past 10 years. You must remember, and I know I've used this before, Mr. Bernanke's famous assertion, I believe in late 2007 or 2008, that the mortgage-backed security crisis, the housing crisis, is contained. Contained in what? The Fed, that great expert that we have permitted to run the economy, had no clue what was coming, and neither did anybody else. Now, I'm not saying the Fed is any worse than anybody else, it's not, but it's also not any better. Its assumption of knowledge, ability, and the ability to prognosticate, to look into the future and control things is really no better than anyone else's. If you look at history, and I'm not taking the Fed to task here, it's also true of the other central banks, on their ability to forecast. It's woeful. It's terrible. It's no good. They have no more insight into what's going on in the economy than anybody else. But they have a great deal more power. And one of the sources of that power is their own assumption that they know what they're doing. I started out this the write-up for this webinar by saying the logic of very low interest rates is severely self-limiting. What do I mean by that? Well, if the linear relationship that I've been speaking about is accurate and true, then why do we do anything else? If a permanent regime of zero interest rates makes the economy grow, then why would we ever raise rates? Why not just enjoy paradise? I've been watching a number of old Star Trek episodes in the evenings. You know, they're only 45 minutes. They're only 40 minutes. They're 50. These amazing things are 50 years old. But many of the themes are about, and it was one of the favorite themes of Roddenberry, that mankind is meant to strive and to earn, to work, and in the complicated relationships of good and evil, you find progress. In other words, utopia doesn't work. Almost every utopia in any of the Star Trek episodes written by many authors is dystopian in some fashion or other. They don't work. And they don't. So this is the same idea here. The sense that low interest rates will deliver growth permanently. Now, there are two concepts here. One, low interest rates in this period here, right after the financial crisis, are eminently defensible, I think. One, things really were in bad shape. I don't deny it. I remember it very well. Lots of friends on Wall Street. My wife was a Wall Street executive, so we have many personal connections to what was going on. And a lot of it was a sense of confidence, which the Fed can't address. Just do something. The Fed's only got one tool, basically, and there were two tools basically out there. You say 2.5. The Fed has interest rates. The federal government can spend money. Those are the two big tools. That's kind of it. There isn't a whole lot more. The half a tool is how the Fed, not the Fed, but the government regulates the economy. They can regulate the economy to death, which they're in the process of doing right now. That's it. On the macro level, that's about it as far as peacetime economic tools go. You can argue about the details a great deal, but you can look across the Pacific at China, and China will tell you that that's what you have to work with, because how has China supported its economy? By spending money or by creating loans to spend money. There aren't other ways of doing things. There aren't solutions out there that are unthought of. There aren't untried inputs for the system. The system is as it has evolved, and it's a finite system. Okay, so the assumption that cutting interest rates to zero was the proper thing to do in the wake of the fall of 2008 is probably the correct assumption. The problem that we've encountered is the linear relationship assumed is not true. It's the quantum mechanics problem. at nano distances, different rules apply. And the second is that if you are defining your policy by standard economic parameters, in other words, you are using your interest rate policy as you have always used it. That means as a counter-cyclical policy. The problem with that is that this was not a counter-cyclical application of the policy. So the counter-cyclical evidence that it's time to switch policy never came, because the assumption that this was the same, and there are a number of books out there, people talked about this at the time. The famous one is the Rogoff-Reinhardt book, which was later criticized for some sort of data problem. I don't know what it was, but the thesis always rang true to me, that this is not a business cycle recession. So you're using the policy in an emergency, not a counter-cyclical business cycle application. But when you turn around after some time and start to think about removing the policy, returning to a more normal thing, what you're looking for as evidence is cyclical, and you're not finding it. That's why the Fed has been unable to raise rates for 7 years. And even if they raise rates in December, I don't see anywhere on the horizon in any economy the kind of growth potential that will bring the Fed back to a normal rate hike cycle, or anybody else. Again, I'm simply using the Fed. I'm not picking on the Fed. I'm not picking on Janet Yellen, who went to the same high school that my wife went to. Actually, not exactly, but they grew up in the same place. Bay Ridge in Brooklyn. So there are the twofold assumptions here that went into the Fed policy. The one that's correct is that the Fed had to do something, and the only thing they can do is lower interest rates. So bloody well, let's lower interest rates, okay? But the assumption that the linear relationship between the economy and interest rates is always true wherever you are on the interest rate scale is wrong. And I'm going to prove it in a minute or two. The second one is that the evidence that you're looking for to go back to normal rates is also wrong. You are looking for normal economic evidence, and you're not going to find it because this is not a normal business cycle recession. Okay, so let's look at the results in the United States of the Fed policy. Okay, let me just use this one again, and then we're going to move on quickly. Okay, you can see the relationship. It's a very rough relationship between interest rates, Fed funds right here, and economic growth. Okay, let's go back to the 80s. So we'll start here. The Fed raises interest rates. The economy plummets. The twin recessions of Ronald Reagan's first term. Interest rates start to come down. The economy zooms into recovery. Interest rates come down. Here it wanders through. Rates were raised back here. We have another recession. Rates come down. Things come back. You can see the gyrations are reducing in their amplitude. And here we have the same thing, right? Rates go up, stay high, economy comes down, economy goes back up. Okay, you can see that there's a relationship, as rough as it is, between interest rates and economic growth here in the United States. What also can you see here? This, where's the scale here? Okay, down here. This fall off at 2008, rates come down and stay down. And if there is a relationship, it's undiscovered. Because what has happened since about, this is I think about 2012, now 4 years, you were bound to get a recovery in this little bump right here. because of the depth of the fall. It's kind of that simple. But if zero rate policy, in this point, in effect for 4 years, where is the acceleration in growth? There is almost none. The economy has averaged 2%, or maybe 2.1 or 2.2% through this entire period with essentially zero interest rates. If there's a linear relationship here, I don't see it. Okay, let's look at other statistics. Which one is this? The 1975. No, we already got that one. Okay, I put that one up twice. Sorry about that. Look at the Fed's favorite. Non-farm payrolls. Okay, non-farm payrolls. Interest rates, 1970. Here we go. Rates up, down. Rates down, economy, rates down here. Economy goes up, rates down here. Economy, you can see the relationship here. Rates down, late 2007, I believe. Recovery and then stability. It's not that this is a failure. It's that it's not produced by that. There is no linear relationship that's discernible once rates hit zero. Let's try another one. This is CPI, another Fed bête noire. We have the same thing. Inflation is white, Fed funds yellow. The inflation of the late 70s and early 80s. Oh, we should all thank Lyndon Johnson and Richard Nixon and their policies. Anyway, you can see through this period, the entire period, the linear relationship, as bumpy as these charts are, the linear relationship is clear. There is a trend from left to right, from higher to lower. But it looks, now remember what we're looking at here, this is inflation, which the Fed supposedly wants at 2%. So the relationship that is evident here through this period, that as rates come down, now what the Fed will say is that rates are following inflation down, that the higher rates somehow changed inflation perceptions and therefore permitting the Fed to lower rates. And I think that is ridiculous hubris to think that a change of policy from a Fed central bank over 5 years changes the assumption. What has happened, and I think is more likely, is that the monetary growth diminishes, and therefore you see a change in inflation. Now, what you're looking for right here, now remember what this is. Lower rates, lower inflation. It's a very clear relationship. But at this period here, what does the Fed turn around and say? Well, lower rates are going to create inflation. What does the chart tell us? It tells us that lower rates foster lower inflation. That's what that chart says. Anything else involves rationalization on top of what's here. And what do we see once the Fed institutes zero rates? Lower inflation. Why could that be? There are a number of things that I think are going on here, but the evidence is clear. The assumption, remember, this is an annual price chart. So this bump right here is the base effect of this fall. You have to go over here before you find an accurate depiction of what's going on in the economy. Okay, so we have in front of us, as much as we can ignore it, and the Fed pretty much does, a relationship which requires an explanation. Okay. Let's look at interest rates. And here there's no surprise. The 10-year in yellow, the Fed funds in white, the 2-year generics, both of them, treasuries, in green. Now, this is exactly what you'd expect, of course. So it's not only the Fed funds rate, but market rates, in essence, follow these programs. They follow the lead. So is there something, and it's not just Fed funds rate, is there something in a very, very low interest rates that does not, to which the economy does not respond as expected? Let's take another look. U3, unemployment. Okay, look what we see beforehand and look what we're seeing now. Very peculiar. Rates go up here under Volcker and unemployment skyrockets. Take a look at that, 11%. Rates go up in the late 80s, and what happens? At a delay, unemployment goes up, and it happens again. Rates come down, happens again here, happens again here. What hasn't happened here? Okay. So rates go up here, unemployment skyrockets. Rates come down and stay down, and unemployment comes down to 5 and stays there. Now this is sort of what you'd expect for this chart. Part of the problem with this, with an explanation on this chart, is this chart right here. And here there's not much relationship that's really discernible. This is a labor force participation over almost 2 generations now, 46 years. And this has a great deal to do with the unemployment rate that I showed you. The way the U3 rate is calculated, in order to be counted as unemployed, you have to have looked for a job actively in the prior month. And for many people, that's not the way things actually work. So once you stop looking for work in the prior month, you're taken out of the rolls. Another thing that's true of the unemployment rate, the U3 rate, is that part-time work is counted as a job. Oh no, I'm sorry, that's non-farm payrolls. Excuse me. No, that's unemployment rate as well. Part-time work is counted as employed. But as far as its economic delivery to the economy, part-time work is only part-time delivery. Okay, let's look at another one here. Let me just look at the U6 rate. Did I bring that one here? Let's look at this one a little more. This is a little more. Let's look at industrial production. Industrial production. Rough equivalence and what happens here. Look at especially this part down here. This is annual, year-to-year industrial production. Every one of these falls is a recession. This one. This is not a recession. This is a recession. This is a recession, right? So recession. No recession in the early 90s, although industrial production took a dip. Recession here and very deep recession here. We're now below zero again. This is not the relationship that's expected. This period of low interest rates is supposed to foster economic growth, not by this chart, at least. Okay, let's look at personal income. The reason I chose personal income rather than wages is because although this is it's just as good. It just this chart the data goes back much further. Again, look at the rough equivalence. I mean, you can. Is there a relationship here? Yeah, there is. I can't define it through an equation, but there's a relationship. But what happens here? No relationship. Things seem to be operating independently of what's going on here. Okay. Fed funds rate, personal income, year to year. Industrial production. Oh, I just looked at this one. Sorry. Real personal spending. Corrected for inflation. Unfortunately, this particular chart only goes back about 16 years. But look at the relationship. You can see it until we get about here. No change. No goes up, comes down, but it doesn't seem to be related because it's not. Okay? Retail sales. Another one. It's tough to find a relationship from economic data that corresponds to the expected result from a long, prolonged period of low interest rates. Let's look at the one place you should expect it, right? CPI. If there's anything monetary policy tells you, monetary theory, that if you flood the economy with potential currency, liquidity, you're going to get inflation. But again, look at this chart. This is CPI year to year. The only relationship we seem to see is that the relationship continued. It's the one I spoke about earlier. Low rates produces lower inflation. If that relationship isn't remotely true, then there are a whole lot of economic research that needs to be revised, shall we say. Okay, PCE core, the Fed's preferred. If I write that another time, I think I'm gonna you can end up writing the same adjectives, the same phrases to describe the same things all the time. Anyway, same thing. So we have a relationship. It appears to be that lower rates produce lower inflation. Oh, could that possibly be true? Is there a difference between the relationship between economic performance of an economy and interest rates at different areas? It's my contention that, of course, there is. Now, what could possibly be the purpose, the result of what we're seeing here? Which is why, to get back to our topic, the central banks are in deep doo-doo, as they would say. Back to what I said earlier. You have an emergency policy applied as a counter-cyclical policy that is looking for the standard types of counter-cyclical evidence that the policy is working. The assumption being twofold, both of which are wrong. One is that this is a business cycle, a cyclical endeavor, a cyclical problem. And two, that the relationship, which is evident and logically apparent and evidentially apparent between economic growth and interest rates at other areas on the interest rate curve is also true at zero. Both of those assumptions are wrong. The first one, I think, is self-evident. This was not a business cycle recession. It was a balance sheet recession, or whatever term you want to call it. Far more difficult, far greater recovery period. I think that's true. The second is in a notion which I don't think any of the central banks, or maybe they did, but they decided since they have no other tools, this is what's got to be done. Remember, if the Fed is going to do something in 2008, it's the only one thing it can do. It can cut rates. When cut rates doesn't work, it can do quantitative easing, which is essentially the same thing. There isn't any other tool sitting there waiting to be used. That's it. The problem they have is that once in, it's tough to get out. You can check in, but you can never leave. What is that? You can check out. A great line from Hotel California, you can check out, but you can never leave. Or the old Roach advertising, they check in, but they don't check out. Either way, the problem in the period we're seeing now is that the effects, and this is most evident, I think, in the past 3 years, the prolonged, and the effect of low interest rate changes over time. And I don't think this is something that the Fed or anybody else anticipated, or at least they didn't think far enough ahead, or they never experienced, or whatever. But since they were looking for standard evidentiary proof, economic evidentiary proof that the economy was recovered, they couldn't raise rates until they got it. But they never received it because the compounding effect of negative interest rates is detrimental to growth. Now, no one had ever tried this before, so nobody knew. But it seems clear that even if the theory hasn't caught up with it, because they don't want to admit it, but the evidence is in front of us. A prolonged period of low interest rates distorts the economy. The economy does not grow as expected. And so when you're looking for the reason to move, as they say, you're stymied. There's no sign of heating inflation here. There's a little inflation, but there's no sign of rampant inflation. There's no sign of anything, really. So now the Fed and the other banks are forced to consider two things. One, it's becoming increasingly clear, it's been clear to me for a while, but the Fed can't admit it, that low interest rates retard economic growth over time. And the longer you keep them on, the worse the effect. Two, the economy is very close to recession right now, simply because it's growing sub 2%. And if you look at the trajectory is down. The second fact, which must be looming larger and larger at FOMC meetings, is how long do they think the economy is actually going to go without a recession? I can't answer the question, but it's a long time now. Came out, the economy left, recession supposedly in June 2009. So we had 10, 11, 12, 13, 14, 15, 16. That's 7 years this past June. That's very long in the tooth for an economic cycle. So you put the two of them together, you have an economy which over the past 3 years seems to is decelerating slowly. But there's no other way to look at the statistics, right? Let's go right back here. Where's my GDP number? Okay, you know what the problem with this is? I ran this here. Let me just explain it. I realized I'd made that mistake, and I realized I'd done it. This chart the purple line is this is a quarterly GDP chart, and I ran it at 12 periods. So that's 3 years. This graph at this end is considerably lower, okay? It goes down more like this. It's my apology. I realized it after I'd done it. Okay, so what we have are two facts here, and these are the facts which are making it so difficult for the Fed to operate right now, which is why I'm extremely pessimistic looking forward. The evidence is that the economy is slowly decelerating everywhere, not just here. Those 6.7 figures out of China are nonsense. I don't buy them. You can look at the EU. United States, look at Japan. There's no evidence of growth other than artificially stimulated growth. I mean, remember, we're growing at 2% with 0 interest rates. What happens when rates go up? Okay. China is pumping money into the economy. Well, what happens when they stop? I don't know. Japan apparently has given up an interest rate policy because it doesn't work. Okay, again, 20 years, low interest rates, no growth. So the evidence is in front of us. None are so blind as those who will not see or cannot see or are bureaucratically disinclined to see, whatever you'd like to say. That's in front of us too. Even in a normal environment, a normal rate world, a 50-year business cycle history or 70 years, whatever you'd like. 7 years counting is very much an aged expansion. It will recess. And the third is, at raising rates 1% a year, I mean, a quarter percent a year, which is the Fed's current rate cycle. Take us 5 years to get anywhere to 2%. There's going to be a recession then. So the last question is, when the next recession strikes, and it will, what will the central banks do? The central banks didn't know, apparently, or at least didn't countenance the idea that low rates would actually retard economic growth. So they probably should have started raising rates 3 years ago. I get no credit for saying this. It's all retrospect. I didn't know either. But they didn't. Now that the evidence is here, we must ask the question, what will the central banks do when the recession comes? And I'm afraid I don't really have an answer for that because there are no magical potions in the Eccles building or in Frankfurt or in Beijing or anywhere else. So the policies can only be more of the same. There are high-powered committees, I guarantee you, in every central bank in the world, at least the major ones, working on this right now, trying to come up with some idea, because this is going to happen. And we will have to wait, I guess, to see what the answers are. But I don't, so far at least, I haven't seen any evidence that there is some sort of untried tool out there that the central banks can use to enter the fray. The end result of this central bank hubris is not yet written. Okay, folks, I thank you for your attention. I hope this has been interesting, if a little apocalyptic. If you have any questions or comments, you can address them to me or to Adinda or anybody at FX Street. And I will see you next week. Everybody take care. Bye-bye.